This week's episode of Taking Inventory is brought to you by one of our sponsors, Meet Market, your AI assistant for e-commerce marketing. Market isn't just another growth tool, it's a member of your team, helping you keep a pulse on your business and trained to save you time and make you money. It's also co-founded by James Barrow and myself. Visit us at withmarket.com. Now, let's get to the podcast. Today on Taking Inventory, here with Daniel Druger and James Barrow as we welcome Rohit Kulkarni onto the podcast. Rohit, welcome.
Hey, thank you for having me.
I think let's just dive right in. You're right now at ROTH MKM. Can you give us a little background about what ROTH MKM does? I know they acquired your first company. You've had a long history as kind of an institutional investor, analyst at a number of financial institutions. So just if you can walk us through the journey you've had.
Yeah, absolutely. So Roth MKM is an investment bank. So they are focused more on serving emerging growth companies and their investors. By that, what I mean is a company that is more on the smaller cap side and is looking to tap into capital markets, trying to raise money, trying to go public, trying to acquire another company. They come to Roth MKM, and seek advice. As part of an investment bank, the role that I play is being an investment analyst. So I follow publicly listed companies. Think of Google, Amazon, Facebook, as well as Pinterest, Snapchat that are listed on Nasdaq or NYSE, and I provide stock recommendations. What I tell my mom is, I'm sure you see some CNBC or Bloomberg. There are these guys who go there and just tell, hey, I think you need to buy shares of Apple because of these three reasons. I'm one of those guys. That's a shameless plug there. But on a serious note, it's my job to ensure that institutional investors, people who want to buy stock or hold stock in these large companies, know what could happen with their investments and whether it's a good time to buy or sell. And I try to stay intelligent by talking to people like James on a regular basis, as well as a lot of people in the ecosystem. So that's a quick background, but again, glad to be on this show.
And for you, like, I've seen you on CNBC numerous times, and when you're doing that, and I know this has nothing to do with ads, but we'll get into it. But is the audience there? Is that like a little bit? Is that talking to retail? Is that still talking to institutional investors? Or like, what's like the like the for you kind of like the core purpose of doing things like that?
When it comes to CNBC and all things media, you typically are hitting more retail people. Typically, your average Joe looking to pick stocks by watching TV. But from a thought leadership, from my own personal brand, from my company's brand, it helps. TV and traditional media is still creates a good top of funnel buzz in a way that posting on LinkedIn does not. I would just call that out straight up. And it's more on branding and brand awareness for me, for what I do, as well as for my company. So that's when it comes to going on CNBC and trying to act as a thought leader. Act as a thought leader being the key word there.
And on those shows and on those segments, I mean, you're on for 2 minutes, but I imagine you and your team and your company are doing, hours and weeks of work to come up with those recommendations of, that gets boiled down to buy, sell, hold. And so what is that process that your team goes through or that the industry goes through to ultimately make that recommendation and have that be dynamic, from quarter to quarter as announcements are made?
Yeah, I think it's always a work in progress. It's a evolving mosaic of various different knowns and unknowns that one is trying to fill out. So the companies provide their financial reports every 90 days. CEOs and CFOs of public companies, they host these earnings calls. People like me log on to those earnings calls along with hundreds of others who log on. We ask questions and try to get more information. We synthesize that qualitative information into a quantifiable number, which is the stock price of that specific company. And once you synthesize everything in that stock price, it is directional point of view whether the stock price is going up or down. And then on a regular basis, we are trying to come up with How is the market growing? Is the market share of this company growing? Are the unit economics of this company growing better versus peers or worse than peers? What are the longer term growth drivers? How are the management team shake up happening, and so on and so forth? So the list of things that one can do to analyze a company and come up with a stock recommendation is endless, and that's what makes an efficient market, and that's what makes the job that much more intellectually stimulating, where what worked yesterday won't work today and definitely won't work tomorrow. And so it's an iterative process that you continue to evolve and try to be intelligent. And this may be a bit of a long-winded answer, but there is also a game theory aspect in all of this. There is you're at the end of the day, you're trying to outsmart the other sellers on the platform if you're a buyer, or if you're going to outsmart other buyers on the platform if you're a seller of a stock. And so that game theory aspect makes it that much more interesting, where in some cases you're gamifying the stock price, and in some cases you're actually applying true fundamental analysis. So all of that combined is what an analyst does. And as I said, what may work today won't work tomorrow.
And from that perspective of like the gamification side, is it's like kind of like for you, when the a couple years ago, like ZERP and all these hyper bull markets, it's effectively at that point like sort of the game is on, and it's your job to basically help people understand, just given the reality of the situation, this is what my suggestion is and how you play it. Is that kind of like what you're referring to, like the game and like momentum of it, or is it kind of beyond that?
That is part of it, where you are relying on the momentum and what directional point of view a majority of people are taking. So if you don't want to be caught out in the minority of the flow of things, although your point of view may differ from them, so that's a momentum part of things. But alternatively, when gamification of stock market comes into play, when particularly you're trying to take a very negative point of view. There are a lot of signaling effects that if a public investor tells the world that I'm very very negative on this stock, it can lead to unlimited or infinite losses if everybody in the world starts to know that. That's the way short plays on stocks work out. So that there are the gamification side of things is where I would rather signal the world that I'm very positive, and the negative sides of things automatically bubble up, and that helps my position as a short seller on the stock. So that's just one aspect, but as you're right, like there's a momentum aspect, there is a signaling aspect. All of those come into play on top of what the real company is doing as such.
One thing about like, kind of our audience is like we do have a lot of people who are like product managers at some of these publicly traded walled gardens, some of them that are private. And I remember when we were back at Snap, we were involved in, writing, the earnings letters, stuff like that. And, we always would read, you know, analysts, points of view on us at Snap. And it would be like, they talked to some agency and the agency was negative, and we were like, did they talk to XYZ person who like we think is just doesn't get the script? But is that stuff important? Like, are you guys going out there and talking to the ecosystem, and is that something that you think that like the stakeholders should be aware of and sort of cognizant of, that like kind of the broader ecosystem gets a vote, even if it just may or may not be the case?
Yeah, absolutely. I think it's almost like the case of six blind men and an elephant. That story where we are trying to determine what the by touching and feeling things that the company is not disclosing explicitly, and trying to fill out the mosaic in a way that is that kind of jives with the story or does not. We are trying to find both sides of the coin, because you can't just take the word of a CEO as is. I need to battle test it. I need to test the other side of the equation as such. So that's part of what we call as channel checks. Channel checks are, we are trying to check on the channel heading into the company, which is suppliers, and suppliers heading into the company, customers heading out of the company. So if I talk to the suppliers and the customers of any given company and make 5 calls on each side, I would get a fair degree of understanding whether the company is telling the truth or are they hiding something that makes me a little bit more suspicious. So that's the more channel checks a person does, the more part of the story you start to paint. And when it comes to, if you're working at some of these companies, think of how many customers and think of how many suppliers you touch on a day-to-day or on a periodic basis. And if a third person would ask some common sense questions to those suppliers and customers, what would they say about your product, about your value prop, and would they say that you're doing a job that is making them more effective? If not, then I would try to find that out.
Yeah, that's interesting because I think a lot of us probably didn't think about like that point of view. I could think in particular, there's a lot of like agency education programs that we were sort of, you know, kind of educating constituents who not would clearly not have become necessarily really large buyers
Mhm.
that we would have leadership kind of have us focus on at times. And I wonder if they understood that aspect of it
That
in
makes a lot more
retrospect.
sense. Yeah.
Yeah. But yeah, it's really interesting.
And how much do you guys concern yourselves with, particularly since you're focused on technology, kind of the nuance of how these systems actually operate? So, like at Snap, internally we talked a lot
Mhm.
about making sure that the auction dynamics were efficient and could scale, but that's not something necessarily people talk to the street about or that can be validated even by customers, right? Customers see anecdotally their performance, or maybe they're
Mhm.
good at buying or bad at buying, but how do you guys dig into the nuance of the technology without having access to the code base?
Yeah. So in terms of like, I would call that as testing inputs and outputs of a black box.
Mhm.
Most of these systems, I think the biggest black box created in the world is Google's ad tech. If you think of it, not many people know exactly what happens on the inside. Although in some cases you feed a number one, it gives you a number three. Again, you feed a number one, it may give you number two or number four. It depends. So by that, what I mean is savvy people would be able to test those black boxes by logging on to ads managers and creating accounts as businesses, which I do on a regular basis. I log on to Pinterest, Snapchat, Facebook, Google Ads Manager, and try to run real money through it and see what happens. It is just play money, so it gives me a little bit of understanding as to what inputs I gave 3 months back, what inputs I'm giving today, and how are the outputs trending as such, and that gives me an indication of whether what is happening in the black box is improving or staying the same or deteriorating. And how does that even stack up versus peers? For example, there was a period in Snap where it started to deteriorate very, very quickly. And we are trying to figure out why is it deteriorating? And oh, yes, it's all Apple. And things like that started to emerge. On the other hand, um, Facebook has started to improve over the last few months or so. So again, testing a black box depends on, you don't need to understand the code. You just need to understand which inputs should give what outputs as such.
And with more, I'm really curious. More and more companies are starting to diversify their revenue channels. So we're starting to see
Mhm.
companies like Uber and Lyft, which have traditionally been rideshare companies, have ads businesses. Instacart, as grocery
Mhm.
delivery, have an ads business. A lot of retailers, a lot of traditionally streaming connected TV, now are heavily ad supported. And so, at what point does that kind of bleed into your domain, or how do you work with constituents that maybe evaluate the ride sharing and travel, but now it's starting to bleed into advertising and things that you're an expert at?
Yeah, absolutely. It starts to bleed in our domain. I think the North Star for all the companies out there is Amazon, the company that built out the three big pillars of internet, unlike anybody else in the world. You have commerce, you have subscriptions, and you have advertising. Obviously, there is cloud underlying everything else. So there is, and then everybody else is trying to follow what Amazon is trying to do. There is a natural way to organically create ad experience for existing customers to create more transactions. So there is always a fine line in how some companies should be embedding more ad experiences as such. Investors feel very bullish about any commerce, any transactional marketplace increasing their ad exposure as such, because transactions are less profitable, advertising is more profitable. So as the mix shift goes more towards advertising, investors start to feel happy about it. That's what drove a lot of Amazon's ads over the last 3, 4, 5 years, and their profitability as well. If Uber, if Instacart, DoorDash, you mentioned travel names, if all of them follow suit, then the profitability would be much higher, um, exclusively based on the ads that they're trying to sell on the marketplace. So yes, it's a positive. It's a very big positive from an investor standpoint, so long as it doesn't disrupt the consumer experience.
A quick break from one of our sponsors. Meet Market, your AI assistant for e-commerce marketing. Market isn't just another growth tool, it's a member of your team, helping you keep a pulse on your business and trained to save you time and make you money. It's also co-founded by James Barrow and myself. Visit us at withmarket.com. Now back to the podcast.
And have you seen, I guess, as you're covering these now, like, is it? I think Uber probably is probably the best example where like it really feels like it is becoming a media business,
Mhm.
like on top of the transportation kind of aspects of it. Have you seen that other investors who haven't had the experience in ad tech that you have over the years, or just like you read some of their stuff, you're like, you guys are missing the script, or has the market gotten smart kind of about all this stuff pretty quickly?
Um, I think market is getting smarter and smarter as they learn more about. I think at the end of the day, what Wall Street wants is better unit economics, which means for every new dollar that comes as revenues, are you making extra profits from that? If the first $100 and the next $100 have the same level of profitability, this business is not improving as such. But Uber is demonstrating that the first $1 billion and the second $1 billion have completely different levels of profitability. And the reason behind that is advertising. That makes people that much more happy. Investors feel very bullish about all of that. So, yes, I think, and when it comes to tech and ad tech within a marketplace, that is still TBD, in my opinion. Who understands what it takes to build a good ad tech platform? We don't know that yet. And whether anybody beyond Amazon is capable of doing that, still TBD. Yeah.
And one of the companies we talk a lot about on this podcast, basically, there's two companies we hyper focus on. One is Snapchat because we're biased and we just think about it a lot, and the other one is Trade Desk because it's like an amazing story, but it's confusing to us that a platform that doesn't own the inventory can be valued in that manner. And so, do you kind of have a point of view on how the market is looking at ad tech infrastructure providers versus the platforms themselves? Like, is there, and we have a business that basically is an ad tech infrastructure provider.
Mhm.
And so we're always trying to map out in our heads, like, is there value capture that can happen there? Or is the Trade Desk sort of an anomaly? I don't know if you have a point of view on that.
So far, the market has said that Trade Desk is an extreme anomaly, not just a normal anomaly. By that, what I mean is, um, I'm old enough to live through a lot of ad tech ups and downs. As in, worked on very early Google IPO, but then went through AdTech 1.0. A lot of memories that I would rather forget from AdTech 1.0. I wouldn't even take names, but there were video companies that thought they were creating video ad tech better than a lot of walled gardens. Then came around display companies that tried to do the same. And again, we are right now on the third, maybe the fourth wave of ad tech. But even in that, Trade Desk has managed to prove two things. One is, they have built enough scale that has created a reasonable amount of durability and resilience versus the three walled gardens. So they are playing for the last 15 cents on the dollar, and then within those 15 cents of the dollar, they are trying to do a better job of capturing greater share and greater unit economics. And number two, they are almost becoming like a Switzerland outside of the three walled gardens. That is kind of goes back to the first point where of those 15 cents on the dollar is that can they capture even better unit economics as such. So beyond Trade Desk, if you add up the remaining 15 public companies, their market cap is a third combined of Trade Desk. So that tells you a lot. Why hasn't even one of those 15 companies managed to take 1/10 the market share of Trade Desk? That's simply because, um, again, there is a certain existential issue that a slightest hiccup by a Google or a Facebook can just wipe out the other ad tech companies in a way that there are existential risks. And when that happens, when investors start to believe that, you get a very discounted valuation to your growth rate, and that's what these companies are being valued at.
So, do you think then? I mean, you mentioned obviously the big three and Trade Desk is this super anomaly. I mean, is there actually an opportunity then in the market for other challengers to come up and try to unseat Facebook or Amazon or Google, or is it really going to be those three, and then kind of a tier two, and then kind of everybody else? Like, how do you view that world evolving?
Um, in my opinion, as in from just a thematic standpoint, we talked about retail media networks, which is what we talked about Uber and the likes like that. The other theme is connected TV. So there are these two themes that where ad dollars are somewhat leapfrogging what the large three are doing and going directly to best of breed pure play companies that are uh, indexed towards those two themes. So that's where currently the market stands. I feel over the longer term, it remains to be seen. But if you pick the spot which where the shadow cast by one of these three companies is not long enough that can overnight disrupt your business, and the way you do it is through thematic um, focus. In you wouldn't want to create a mobile app download business right now. You would rather focus on things that these companies haven't been able to crack as deeply into, and that's how we create a more durable business. So.
And then kind of switching gears a little bit to some of the platforms themselves. One thing that we think about a lot is just like the impacts of TikTok on kind of all things. In some sense, TikTok, we look at what they're doing now on commerce, like definitely is making an impact, at least on how Amazon is sort of approaching things and how Meta and even Snap and Pinterest are. Like, I don't think a lot of those partnerships that you hear about and that they put in place would happen if TikTok wasn't getting so serious about e-commerce.
Mhm.
Do you have, is there a kind of a good way to think about like what is the impact of TikTok kind of on the ads market in the US and maybe even some of the other Chinese companies that are becoming large advertisers? And then two, if they were to be banned, is there a framework to kind of think about of who would benefit and what opportunities that would open up?
On the first question, I would say it is still TikTok's impact on which part of the advertising funnel is the deepest is still remains to be seen. You guys might be more in tune with the reality there, but from an investor standpoint, at some point last year, people thought that TikTok is going to disrupt the bottom of funnel advertising, which Facebook has done very well at. So far this year, the investor mindset has gone away from that, and probably TikTok is more of a mid and top of funnel reach and awareness kind of a play. If that's the case, then TikTok probably is taking away share from the companies like Snap and Pinterest, and not so much from companies which are much larger like Facebook and Google that have essentially created an extremely solid mousetrap for bottom of funnel marketers. So that's kind of where TikTok is still figuring out its best spot in the ad ecosystem. I feel they started off at the bottom and now are in the middle towards the top based on reach and frequency. If TikTok were banned, my honest opinion is the likelihood of that happening is low and getting lower as the days pass. But having said that, that's still a non-zero probability. And if that's the case, mostly the companies that I just mentioned that they are probably taking away share from, Snap and Pinterest, they start to benefit the most. Probably YouTube also starts to benefit a little bit, given and that's part of Google.
Alongside the discussion of kind of a TikTok ban in the US, there's a lot of talk of obviously the FTC in the US, EU, UK regulators, just a ton of regulatory oversight
Mhm.
around the big technology companies. So obviously TikTok being one of them, but also Amazon, Facebook, as it relates to data sharing, antitrust, anti-competition, things like that. What is like what do you make of kind of the regulators coming in and really trying to police these big players across the board? Like, is this a good thing? Are they overstepping? Like, what's your general thought around it?
Um, in my opinion, to foster competition, we need some guardrails around larger companies. Whether U.S. government um, has the resources as well as the will to be able to do that, it remains to be seen. Um, so far, all the positive guardrails have come from Europe in the last 3 to 5 years. And even if you look at what happened in the last week or so, the AI regulatory kind of updates that we heard from Europe, they are moving at a pace that is much, much faster than what US authorities, FTC, or any other authority is trying to move. So I feel, yes, it is something that should help with competition, but I would be very surprised. Apart from some small slaps on wrists of these large tech companies, there is anything that U.S. Federal or state governments are able to do anything. There are these. We just are in the middle of the biggest antitrust trial of our generation. The last antitrust trial was Microsoft, which was when a lot of people were in high school or even younger. But how much have we heard about that in the last 2 months? Every CEO and every big tech person has come on stand and given the testimony and come out of the court. But I would be very surprised. Come February, we are going to hear something extremely negative from that one single judge asking Google to clean up their act as such. So that's the power of big tech right now. That's what worries a lot of smaller players. And let's see if there's by February is the first time we'll hear from this judge about what potential guardrails they could have around a company like Google. That would set the tone for what Amazon could face in a couple of years when it comes to their monopolistic power over e-commerce in the US.
Yeah, I mean, this one is certainly big, but it is interesting, and you mentioned it, that a lot of kind of the biggest regulatory decisions or oversight or things put in place have come out of Europe, which is typically a smaller market than North America, or in the US at the state level. Obviously, California with data privacy, Montana passing the anti TikTok, which obviously they're not going to be able to enforce, but kind of coming at the two extremes, kind of a smaller market
Yep,
commercially than the US, and then state level decisions. Like it does seem a little
exactly.
odd that the federal government is a little much slower to act on both sides.
Yep.
Yeah, and one thing on the Google side that I've thought about a bit is just like, in some ways, and you see this happening with Google with PMax, like they're just becoming Meta, right? Like, I gotta say, like every social network is going to become Amazon to some extent,
Mhm.
maybe without distribution, but will be a place that controls screen time, and they'll sell you stuff, and then every ad platform becomes an objective based buying wall garden ad platform. If you were big enough to justify to do that, it's like a no brainer. And for Google, I know people, especially kind of people more on the open web side, have a lot of issues with their practices with the Google sort of ad network assets. But to some extent, they have YouTube. YouTube TV is killing it. YouTube, on Roku apparently is doing incredibly well. Like they could de-emphasize their ad network in many ways the same way Meta has,
Mhm.
right? You really don't hear about audience network much. And and it may not be a bad thing for their business. And actually, in some ways, the margin profile could change a bit too. Like if that's the outcome that happens from this, you know, is that like from a regulatory standpoint, it's kind of accomplished nothing? Is that a likely
I think so. Yeah,
thing?
I agree with you. I agree with you, Daniel. As in my opinion, what could U.S. government do? Could they force Google to spin off a part of their ad tech? Would they force Google to spin off YouTube? Investors would start cheering if something like that were to happen. So investors are almost like heads I win, tails you lose in this situation. And maybe $5-10 billion in fine is something that Google could actually generate that cash in a couple of months, to be honest. So there is very little, in my opinion, that at least from an investment community, something extremely draconian could come out of what is happening from a regulatory standpoint.
And then one other thing too I was just thinking about is the for some of our friends that are at some of these private, but most likely soon to be public ad related businesses.
Mhm.
You know, a lot of the questions that they have is like, okay, listen, like I want to build a marketplace for economically rational advertisers. I want to make sure the unit economics make sense. Like I want to build a real business here. But there's that other tension of go out and prove you can get demand first, and then go ahead and show to the market you can make that efficient demand. Is your take that the market will give you a pass if you can show you can generate demand and then you can clean it up? Like, has that been sort of what investors have said over time? Is that a fair?
I think so. Yeah. If a company can demonstrate exactly that, I think there is room for an investor appetite for companies that are able to demonstrate exactly that. And also, um, bear in mind, like we have been in the last 3 years since 21, we have been in extremely unusual circumstances when it comes to advertising, internet, and markets and whatnot. When it comes to 24, we are looking at almost like a recovery where 21 was fast, 22 was slowing down, 23 was the slowest, and now 24 in 2024 there is acceleration, and acceleration is the best word that investors can hear as such, and that's where the industry is going. So we like, and if there is a company that is willing to demonstrate that on top of the acceleration that is expected, that is going to have a lot of investor appetite.
Yeah, that's a good place to kind of wrap things up, Rohit. You know, looking into 2024, 2025, kind of what is your general outlook? Kind of, do you have any non-financial advice predictions?
Um, I would say in the year of 2024, probably the expectation of the market is accelerating growth in internet. Internet has slowed down significantly from the COVID peak into 22 into 23. So 23 is the slowest growth that internet advertising has had in probably more than a decade. Um, and and 24 is going to be faster than 23, and there is a scenario that 25 could be even more faster than 24 if we do not have a very large external shock. And given where I don't have a macro crystal ball, but if we are not in a recession, if interest rates are going to fall, if inflation is going to fall, that creates a lot of growth capital. And when you have growth capital, you do one of the two things: you either hire engineers or you go and spend on Google or Facebook. Um, I'm sure they spend 15 cents on other platforms that are not called Google and Facebook of every dollar. But that's what happens. And we expect that to happen even more of in the next 18 months as compared to what happened in the last 18 months. And if that's the case, we are sitting at this curious little juncture of accelerating growth, positive momentum, and that should bode well for stocks going forward.
It sounds great. I'm in. Sign me up. Yeah. my portfolio will kill it. Well, thank you for doing this. I know you obviously have a ton going on, but we really appreciate it. And for listeners, if they want to find you on Twitter, LinkedIn, TikTok? What's the easiest way to follow you and keep up on everything you're up to?
LinkedIn is the best. Yeah, just search my name, Rohit Kulkarni, and maybe add Roth, ROTH to it. You'll see my profile there. Happy to answer any questions. Happy to give you non-financial advice or provide a more point of view into what we do to help move the markets.
Awesome. Well, thank you again for doing this. We really appreciate it.
Thanks. Thank you, guys.
Before you go, we need your help. If you enjoyed this week's episode of Taking Inventory, then subscribe or rate wherever you listen to the podcast. And while you're at it, please share this episode or your favorite episode with a friend. We'll be back next week with another episode of Taking Inventory. See you then.